Happy morning, friends. Welcome back to IRDA IC38 exam refresher preparation. We are getting into the chapter 3 now, and I am sure you would have seen the first two chapters as well as checked on the sample questions available in the Q&A video. Right, so we covered what life insurance involves in chapter 1. We also saw in detail about financial planning in chapter 2, and we are going to start about life insurance product which are traditional in nature in chapter 3. So let's understand more about the products from chapter 3, and most importantly I am reiterating the points. Though the entire objective is to focus on clearing the mandatory examination, I urge you understand the basic concepts well so that this will be useful for you in a long run to be successful in this business, right? So let's move into the contents. Life insurance products which are traditional, right? So what is traditional life insurance products? They're typical, should I put it in simple terms, savings solution is a product in life insurance, right? So let's see various variants about life insurance product, what are all available today, and how effectively it can be useful to our probable consumers, right? So before moving into life insurance products, first let's understand what is a product. Any commodity or a good sold in the market which can be bought by the end user is a product which is bundled with some features, right? So and these products can be tangible in nature. What I mean by tangible product is a physical object, for instance a mobile, a car, a pen. All these becomes tangible physical objects. There are also intangible products where you cannot touch and feel the product, but the product has its own benefits. For instance, any investment product you cannot touch and feel, but the product has its benefit. Let's stick to the example of a life insurance policy. The product is bought by an end user, sold by a life insurer through the distributors, and the agreement is in the form of a physical document. We cannot touch and feel the product, but the product has its own benefits for the end user, right? So what is the purpose of a life insurance product very specifically, right? So life insurance as a product will take care of protections against any loss for an individual customer. So if there is any economical loss for the individual customer, if he is insured through the right solutions, the loss will be compensated by the life insurance product. So when we say life insurance, we are referring to covering the life of human, and so the loss which will be covered can arise due to death or a disability, right? So just elaborating more on the purpose of life insurance, it is not only contingency planning. Life insurance has become a bundled product in the market now, through which we can plan our long-term savings. You can take care of safety of your investments. There are products which will take care of wealth accumulation, and there are also products which will give you good rate of returns linked to equity market. So overall bundled features which are used by individuals depending on their requirement. So this is purpose of life insurance products. So moving on, how do I understand the suitability? Which customer needs which particular product? If you recall, we saw in our financial planning session, which was chapter 2, how different phase of life will be determined for an individual customer, and then based on that a suitable product to be taken by them, right? So similarly, IRDA has created a concept of product suitability, right? So which reduces mis-selling in the market. So that means a right product for a right customer. So agent should be justifying on why this product has been given to this particular customer based on the suitability of the product. So continuing with suitability information, it is made a little more structured here. The suitability information has to be agreed by the customer as well as the agent, and it is preserved by the insurance as part of the policy records. So this is one interesting initiative where identifying the suitability of the customer and then suggesting a product came into market of late, right? So moving on, we are discussing life insurance products. So moving on, let me introduce you to riders, right? So riders, in addition, as the name says, a rider is nothing but it is an add-on benefit coming along with the basic benefit. So to increase your benefits, of the product chosen, we would add riders to the existing basic product, right? So there are different kinds of riders. Yes, we will know about it in the subsequent slides. Just to add more, various types of riders, as I said earlier, there are different types. There is a disability cover. For instance, this rider, when taken along with a basic policy, if at all the policy holder is suffering from some disability due to some accident which happens, the rider will come into force, and the benefits will be enjoyed by the customer, right? So similarly there are critical illness cover. For instance, a list of critical illness are given along with the product, and if some customer has some policy holder has chosen critical illness cover along with this basic policy, and if at all there is any one critical illness onset happening to the policy holder, they can claim the critical illness sum assured for further either for you to be used for the treatment or for sustenance of lifestyle. There is an accident cover, which is again a rider. If at all the death of the policy holder happens due to accident, the policy holder's nominee will be getting additional benefits. So in simple terms, various riders are existing depending on the comfort and convenience of the customer. They can add this along with their basic product to enhance the benefits. We'll move into types of traditional life insurance products. So we will understand more about what is a term insurance plan. We will understand more about what is a whole life insurance plan. We will understand an endowment insurance plan as well, right? So these are the traditional life insurance products which has been in the market for long years with its own benefits reaching the customers, right? So let me speak more about the term insurance first. The fundamental basic protection product which is available in the market from life insurance is the term insurance product. So term insurance can be short term in nature, right? So or a long term as well, right? So the protection to the individual will be up to age 65 or even more, right? Or less, depending on the choice of the term of the customer. So there is no savings as an angle attached to these kind of products. The objective is pure protection. So I would like to introduce a new series of product called Saral Jeevan Bima. This was mandated by IRDA in October 2020. Life insurers have to have this Saral Jeevan Bima as part of their product portfolio. It is a non-linked, non-participating, pure individual risk premium, right? So don't get into the terms. We will understand all these terms in a short while, right? This product is a pure protection plan, and it provides sum assured to the nominee in case of death of the life assured, right? So this product is offered without any restrictions. That means it makes the product much more simpler. And for the newcomers, I am again repeating, you need not worry about any of the jargons used in the book or any of the terms used in the presentation, right? So in case if it is new to you, you can text us, we will revert back, or you can discuss with your seniors for understanding the terms. In this slide, very specifically, Saral Jeevan Bima is referred as a pure protection plan. That means on death, a sum assured will be paid to the nominee. It says this product is non-linked. Linked meaning this product is not linked to any equity investment. Non-participating meaning there are certain products which we will see where every year the life insurer will be declaring the bonus, right? So that is participating product. So in this case, since there is no savings attached to a pure protection plan, it becomes a non-participating. So you learned few new terms in this slide: non-linked, non-participating, and pure protection. Okay, we'll understand more about term insurance as a product. The purpose is sum assured is provided to the family in case of death of the life assured. You can add a disability coverage if required to this plan. In some instances, term plan itself can be taken as a rider to the existing policy. Right, so to move forward, there is a set of product called whole life plans. We will see about it in the later part of this chapter. You can convert the existing whole life into a term insurance as well. So what is the unique selling proposition, USP of this product, term insurance, is it is a low price and the coverage is high. Right, so for every product which you are recommending to your customers, you should definitely know the USP of the product, unique selling proposition. So the customer can decide or make a decision on his buying based on the USPs we share with the customers. Right. Moving forward, what are all the variants available in term insurance? There is a decreasing term insurance product. That means it starts with the X lakhs as cover, and by the age of the policy increasing, the cover reduces. Probably you can imagine this will be useful for a loan, somebody who has taken a loan. Increasing term assurance, it starts with X lakhs and keeps increasing year after year. And the lastly, a new variant of term insurance called term plan with return of premium. So as we said earlier, there is no savings as an angle in term insurance. So but the new variant says a term plan with the return of premium. That means if there is if the life assured survives the entire term and there is no death of the life assured during the term, by end of the term the premiums paid will be returned back to the life assured. So three variants: decreasing term assurance, increasing term assurance, and term plan with return of premium. So as I said earlier, decreasing term assurance will be ideal for attaching a policy with a loan taken. Increasing term assurance, year after year the death benefit keeps increasing considering the life stages of the individual. Right, so the new variant, term insurance with return of premium. That means you pay premium for X years and there is no death of the life assured. That means by end of the term, all the premiums paid will be returned back to the life assured. So this comes as an additional benefit in term insurance. Right, so giving few scenarios to understand why term insurance will be, how term insurance will be useful to a customer. Right, so term insurance, it is purely on a temporary basis can be taken, and probably one of the reasons can be a mortgage. If somebody has taken a mortgage, a term plan will help to cover the mortgage. Right, there is also a philosophy of investment telling you buy term insurance, you're covered from uncertainty and you can invest the rest in other forms of investments as well. Right, so this is one thought, and in additional to the existing savings plan, a term plan can come in as a supplement. Right, so this is all about term insurance, and let's move on with the whole life insurance now. Right, so in this variant of product, premiums are paid throughout one's life, and in some instance there is also premium payment term which is limited or specified in nature. So what is the benefit given? I pay premium for certain number of years, and my life for the whole is covered through this plan, and in case of death of the policy holder, the nominee will be getting the sum assured, right? So whole life meaning the entire life of the policy holder, right? So this policy remains in force till the death of the life assured, right? So moving forward, third kind of product which we are discussing now is endowment assurance, right? So this product very specifically has two different benefits. One benefit will be the survival benefit, wherein focusing on certain milestones somebody can start savings, so this becomes more of a savings product. And there is a death benefit also attached to an endowment assurance plan. That means in case of death of the policy holder during the term of the plan, right, sum assured is paid to the nominee. The objective can be understood in this way: there is a major milestone in the family, and the individual starts saving for that milestone, and in case there is a death of the person who has started the saving, this death benefit will take care of replacing the income required for the milestone. So endowment assurance comes with survival benefit and death benefit, right? So there are various kinds of endowment assurance plans. Majority of the plans might mature at the age of 55 to 65. So an endowment assurance plan has to be supplemented with a retirement savings plan as well, so that the retirement part is taken care and the pension planning is done effectively. Introducing more variants of endowment assurance. Money back policy is one of the famous policies available, right? So money back policy is one kind, participating, non-participating plans are the other endowment assurance plan. Let's see one after the other. Money back, a popular kind of an endowment plan where during the term of the plan itself regular returns are given. So that means somebody takes a 25-year policy, and we say that every 5 years 20% of the sum assured will be given to the policy holder as a survival benefit. So that is money back policy for you, and at the end of the term the final payment along with the bonus accrued will be paid to the policy holder, right? So friends, we are not talking about any specific product from any company. We are talking about the product segment on a whole for you to understand the basics, and then probably after your examination, once you move into meeting more customers, for you to understand the product, a very specific product training pertaining to your companies will be extended to you, right? So we are in life insurance traditional products understanding, and the third segment which we are discussing is the endowment assurance participating plans now. So in endowment assurance, what is this participating plans? You take a savings product, you keep paying premium during the term of the plan, and every year the life insurer will declare a bonus for the product which you have taken. So this product participates in the company profits, and that is endowment assurance participating plans. So moving further, these bonus which are declared every year and the additional benefits get added to the basic sum assured, and it becomes part of the death benefit as well, right? So and this bonus which is declared year after year is called the reversionary bonus, right? So the third segment of product in endowment assurance is non-participating. What is this non-participating? I would like to put it in this way. I would say that if the maturity is 100% guaranteed. What is it 100% guaranteed? Right before taking the policy itself, we tell to the customer that the returns or the maturity are 100% guaranteed, and this is the value which will be paid to you, and that becomes non-participating plans. Okay, we were in life insurance product, we saw term plans, we saw endowment product, and in endowment product we saw about money back, we saw about participating, and now this non-participating. So what is this non-participating? The return on the policy is disclosed in the beginning of the policy itself. When a customer comes to take a policy itself, we say that this is going to be your maturity. So 100% disclosure of what will be the maturity value itself is given upfront, and that those kind of products are the non-par plans or non-participating plans, right? So moving forward, a few points to highlight about endowment assurance. Regulation 9 of IRDA says that the sum assured should be a minimum of 7 times of the annual premium if it is a regular premium, and it should be 1.25 times if it is a single premium product. Right, so in additional to term plans and endowment plans, let's also have a understanding of pension and annuities. Pension and annuities are for the retirement years. So somebody pays premium during the working age and starts enjoying the pension during the retirement age. Right, so pension plans are two types shared here. One type is group insurance, group pension plans. That means an employer, it can be kind of an employer employee planning. So second one is an individual. Today not all organizations, not all governments are coming out with a pension plan on their own. So on an individual basis, it is up to the individual customer to plan his or her pension life. So for that, individual pension products are available. So during the working age, the person will be paying the premium to enjoy the pension at his later phase of life. And the investment made to pension plan can be two types. Again, they can make a one-time lump sum and then wait for the pension to start, or they can keep paying regularly over a period of time and then start the pension, which is deferred. And again, adding more to the pension plans here, the annuity modes can be monthly, quarterly, half yearly, and annual. Somebody who's opting to take a pension, they can take monthly, quarterly, half yearly, and annual. There are also immediate annuity pension. Somebody comes with a lump sum for investment, they make the payment one time, and their pension starts from the very next month, and they continue to get the pension for their lifetime, and they enjoy benefits depending on the features of the product, right? So a few additional topics which I wanted to highlight as far as pension is concerned. Pension can be either single life pension. One individual can take the plan on his life, continue to get the pension, and after his life, the lump sum or the premiums he has paid will be returned back to the nominee. It can also be a joint life, a husband and wife taking the plan, and they continue to get the pension for both the lives. For instance, the husband continues to get the pension, and after his life, the wife continues to get the pension, and the premium paid is returned to the nominee at the later stage. In January 2021, all life insurers had to introduce a pension product called Saral Pension, which is a standard immediate annuity product, and it was mandated by IRDA. Like there was a mandate for term plans, this mandate speaks about a pension plan, right? So friends, with that we come to the end of chapter 3, and as usual I recommend you to read the book in addition to watching this video and the Q&A video further for understanding the sample questions. So good luck, all the best, keep learning, continue your learning initiative with the 4th chapter and the further chapters ahead for you to clear the mandatory exam successfully. Good luck to each one of you.